Okay, guys, you are welcome to this lesson. Today we are going to say receivables and payables. Okay, receivables and payables. Right? What is receivable? Right? What is receivable? So now you would have known the what is receivable and what is payable and accounting treatments for that. Receivable means if you make a credit sales, right? If you make a credit sales, the sales goes, the goods are going out, then cash is not coming in, right? This is I am taking this as a separate lesson because you can have a you can get a good idea about receivables and payables. Then this may help you in my future lessons, right? That's what I am taking this receivables and payables as a separate lesson. Okay, receivables means anything you are supplying something, or you are giving something, or you are issuing something out of your business, right? Right, for example, you are issuing the goods going out of the business, right? Business is known as B, right? You are issuing goods, right? Your goods are issued, goods you are issuing to C, right? C, here's the C, right? C, you are issuing goods to C, right? But B issuing goods to C, B issuing goods to C, right? When the goods are issued, what C has to give instead of goods? What he has to give, right? He has to pay cash, right? If B is issuing goods, there is a two type of transaction to take. In one transaction, two types of entries are there. So for these goods, if you issue goods, he has to give something, no? You are not giving anything freely. If you give anything freely, that is defined as donation. That is defined as donation. Understand? I mean, if you just giving the goods without getting any cash, in that case it is donation. This one is, in this case, you are issuing goods, but he didn't pay back the cash. He didn't pay back the cash. But the goods are issued with the 30 days credit. 30 days credit. 30 or 40 days. We say 40 days. 40 days credit. So this is the credit sale. Credit on credit. Here you see goods on credit on 40 days credit credit period. Credit period. So he will settle this amount of value credit for 40 days. Amount is 100, right? 100. We'll say for an example. You issued be issued, right, to see 100 rupees worth of goods on credit, right? The credit period is 40 days. After ending the 40 days or before the 40 days, he will settle this credit 100 rupees. So until that, you will record as a receivable. In your books, you will say it is receivable for him from C. C. Receivable from C. This 100 rupees recorded here in the books of B. What is the double entry in the books of B? He will say debit receivables, right? Debit receivables 100 rupees, and here you will say credit sales sales 100. This is the double entry you have B in the books of B going to take place, right? When you see from the view of C, right? This is from the view of B, from the books of B. We are looking at from the books of B. From the books of C, what is happening? This amount is payable for him. This amount is payable. For receivable for A, payable, this is payable for B. To C, right? This is receivable from B. From this is receivable from C, right? For that only we have made a entry. So in the books of C, this is payable to C, to B, sorry, payable to B, right? Then what is the double entry? What is the double entry? What is the double entry? Right? Debit purchases credit, payables, payables, right? You can say this is payables as trade creditors. Trade creditors. This is trade debtors. Debtors. This is trade debtors called. These receivables called as trade debtors, or these payables are rupees 10, 100, rupees 100, rupees 100. Okay, this is the double entry. Understood? This is from the view of in the books of B. This is in the books of B, right? This is in the books of C, right? This is the dividing point, right? This is the dividing point. So here B, receiving the goods, receiving the goods from C. He is selling the goods. C is receiving the goods. B is receiving the payments, right? Payments. So he is the seller. This person is a seller. This person is a buyer. Buyer. Okay, in the books of seller, in the books of buyer. So now it is clear, na? Now it is clear how it is receivable and payable. I have shown a transaction of sales. For an example, I have taken a single transaction of sales. By using a single transaction of sales, we can define the receivables and payables in the point of seller and in the point of purchaser, right? This is the point of seller's point of view. This is the purchaser's buyer's point of view, right? So this separate set of books are there. So in separate set of books, it will be treated in different way, because seller will treat as a sales, buyer will treat it as a purchases, right? That is the difference. If you identify the difference, it's okay. This is the number one example I am showing to you. Okay, this is the number one in example. Okay, right. This is the number one example to receivables and payables, right? This is the you are one you are issuing a staff loan, right? Staff loan. or advance, right? For from the point of B issuing the loan to D. Okay, this is D, this is B is the entity, D is the employee. Employee, right? This is the business. Oh, business. This is a business. This is the employee, right? Business issuing a loan of 1,000 rupees. They are issuing loan of 1,000 rupees. 1,000 rupees. Okay. If they are issuing 1,000 rupees, it is in the point of B's account. We will say it is the receivable, loan receivable, loan receivable. From the point of D, loan payable. Because he is issuing cash to him, D has to issue cash loan, settle the loan after after 10 months. After 10 months, then they will treat him as a receivable. Receivable for him, loan receivable, loan payable. Here debit and here credit, right? Debit and credit. Staff loan, loan receivable. Credit cash, right? Of 1,000. 1,000. This is the double entry in the books of business. This is also staff loan receivables, one of the receivables, and this is the payable in the books of D. Okay, in the books of D we say debit cash, credit loan, loan payable to B. How much? 1000. Here is 1000. This is the entry. This is staff loan and advances, how it is treated in the books of businesses and in the books of purchasers and employees. Right, it's an employee. This is also one sort of receivable. This is also one sort of payable. How do we record it in the T accounts? Right. Another account, how we can say receivable. Mhm. We can say the taxes, tax receivable, tax payable, right? Those item also we can say at this point of time it is difficult for you all to understand. First of all, understand this receivables and payables. This side is receivable, this side is payable. Right? Now, in the books of B, right? In the books of B, we have to see the double entries in the T accounts, right? In the books of C, double entry seller inventory account is there. One is inventory, so here inventory, this is for number one, right? This is inventory, and rather than say inventory we can say receivables and sales, right? Sales account debit, and we'll say receivables, right? And say receivables, receivables. How he is selling the goods of 100, then cash, the sales is 100, right? Receivables is credited, sales is credited, receivables debited. What is the narration give sales here, sales, here you will get receivables, right? This is double entry for the sales took place of 100, receivables account debit, sales account credit, right? Number two is staff loan, right? Staff loan account, staff loan, oh, receivables, right? Credit, and the cash account, cash, debit and credit. What happens here? You are receiving, you are issuing a cash, you are giving a cash of 1000. That means cash account credit, cash is going out, so cash is 1000, right? Then the second, where you will debit the amount, that is the staff loan account, right? Debit staff loan receivable 1000, Here you will say cash. Here you will say staff loan. Staff loan receivables. Right. That is the double entry for number two. Number one, number two. All are receivables. These all are receivables, right? This side all are receivables. Okay. Now we are going to see in the books of buyer or the person who is receiving the staff loan. That is payable side. Right. This is a receivable side. Right. This is the receivable side. Then now we are going to see the payable side. Payable side. Here it is better to use this side. We will say payable side purchases account. We will open a purchases account. Right. Purchase. Purchases. Right. This is trade creditors. Trade creditors. Trade creditors. This is the payable. This is payable. Trade creditors. What we say, we received a, we purchased for 100. Then purchase account debit, and we didn't give the cash. We didn't make any payment. So creditors account credit. Here you say purchase. Here you say creditors. Okay. What happened here? You are purchasing a goods worth of 100 rupees. So purchasing means purchase account debit, trade creditors account credit. No cash here. Cash is not involved, right? Because of that, we are liable to pay the 100, pay the purchases of 100. So liable means liability. Liability, payable coming under liability, increase in the liability. So we are crediting. So that is that. Payables always credit balance. Will have a credit balance. Payables always will have a credit balance. Receivables always have a debit balance. Keep it in your mind. Okay. And number two, this is the number one. And right. Number two, loan payable. Right. You had to open a cash account. Cash account. Cash account and loan payable account. Loan payable account. How much you are receiving a loan of 1,000 rupees, then 1,000 rupees debited to cash and credited to loan payable. It is the liability, so you are putting cash. So here loan payable, right? Loan payable, right? This is the double entry. So can I give the journal entries for this? Receivables, we will say receivables. For receivables, accounting treatment. 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 Right? For receivables. Receivables. Right? Receivables means receivable account debit, debit, right, right. Here we cannot give a accounting treatment specifically, right? We can explain it with the help of the transactions, right? Here we cannot, there is no such double entry for receivables. We can say receivables account debit and sales account credit, or what you call the cash account credit, or anything else. The benefit account, whatever the benefits we are receiving, that account credit, right? Credit the benefits received account, right? Benefits, or credit to the any benefits received, any benefits, any any goods or services, any cash, any type of TYP, a type of cash or sales, sales or or goods, goods, cash, sales, goods, any type of cash, sales, goods. What else we say? Mm, Gone out of the business, gone out of business, right? That account has to business without the, on the promise of subsequent settlement, on the promise of subsequent settlement. Right? Any type of cash, sales or goods gone out of business on promise, on promise of subsequent settlement of cash. So we can say subsequent rather than say the promise of, on the basis of credit, on the basis of credit. right? On the basis of credit. That is the receivables, right? And payables, payables, right? Any type of cash, sales, goods received, any type of cash, of cash, cash, or sales, purchases, or goods came in to business with the promise of, on the promise of settlement in subsequent period, time period. In subsequent period, subsequent time period, time period, right? That is debit and payables, credit, right? This is the double entry, you can say, right? This is the way I can uh, advise to make the entries, right? Because there is no such a entry for receivables and payables with the help of the what you call, with the help of the examples only we can, with the help of the accounts or examples only we can explain the receivables and payables. There's no such accounting treatment, right? If you say, if we can explain in such a way, receivables are receivables account debit, any types of cash or sales or goods gone out of the business, any type of the cash or sales which have gone out of the business on the basis of credit, or on the basis of promise of, on the promise of subsequent time set, on the basis of subsequent settlement in a time period, subsequent time period, settlement of subsequent time period, right? That is credited. In the payable side, any types of cash, 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 cash purchases, goods came in, right? Came in to business on the promise of settlement in subsequent time period. That is, that account is debited. Payable accounts credited. Okay. Have you understood? Okay. This is the receivables and payables. In this way only receivables and payables can be explained. If you have, I hope you would have understood this lesson. If you have any doubts, let me know. Okay, thank you. So I am concluding this lesson with this, and I hope to see you in next lesson.